Hi, everyone. My name is Michael Clark, Chief Commercial Officer at Agilis. I'm joined by my colleague, Joe Anzalone, Managing Director and Head of our annuity purchase business. Today, we're going to talk a little bit about pension risk transfers and how it relates to minimum required contributions. But a little bit of background before we get started here. The pension risk transfer market, as many of you know, really took off in 2012 with two big transactions, one from General Motors and the other one from Verizon, that really set us on a course that has continued to accelerate year over year, where we're seeing more and more plan sponsors transfer their benefit liabilities to an insurance company. In fact, last year, buy-in and buyout contracts in total, we were just over 45 billion. The year before that, 2022, we were just over 50 billion, which was a new high watermark. That was the first year that we actually, or the second year that we passed that 2012 year. 2021, we did as well with buy-ins and buyouts as well. But this trend continues where we see more and more plan sponsors looking at annuity purchases, pension risk transfers as a way to either de-risk their plans or as part of an ultimate plan termination. So plan sponsors have embraced this. The economics seem to be in their favor. But Joe, let me ask you a question. So what effect, when a company goes through a pension risk transfer and they offload these benefits, they pay the premium to the insurance company, what effect does that have on a plan sponsor's funded status?
Michael, I'm going to give every actuary's favorite answer, which is to say it depends. In this case, it depends on what basis you're calculating funded status on, right? So when we think about corporate financial statements, what goes on the plan sponsor's balance sheet, the funded status impact has been neutral to actually often somewhat positive, where there's actually a reduction in the deficit, where you're able to purchase a group annuity contract for your retirees at a price that is less even sometimes than the balance sheet liability, what we call the PBO, that you're maintaining for those same retirees on your balance sheet. Pricing for retirees is very favorable when thought about in that corporate accounting financial reporting context. Similarly, when we think about the metric used to determine premiums paid to the Pension Benefit Guaranty Corporation, the PBGC, the basis has also been very favorable, very similar, again, sometimes even an improvement in funded status based on the pricing that you can get compared to that PBGC premium liability. And plan sponsors will probably be familiar that there's often other benefits to reducing the headcount in your plan for PBGC premiums. So from a PBGC premium perspective, it's been very favorable. From a corporate financial reporting, it's been neutral to potentially even favorable, just in terms of the size of the deficit. And of course, shrinking the plan reduces risk as well. So from those perspectives, it's generally been considered a neutral to risk reduction, and win for risk reduction, and neutral to positive for funded status. But until recently, that has not been the case when determining funded status for minimum required contribution purposes, or for the dreaded AFTAP benefit restriction purposes as well. The basis used for that is different, and what we've seen until recently is that annuity purchases can be damaging from that perspective, can reduce funded status and cause plan sponsors who otherwise may not have to make any required contributions to have to make potentially significant cash infusion into the plan after annuity purchase.
So Joe, what's changed then? Like with the minimum funding piece, like it's not the same as it was even 2 or 3 years ago.
That's exactly right, Michael. And the short answer is interest rates, right? So for minimum funding purposes, we've been living in a world now for over a decade of what's affectionately referred to as funding relief, where the interest rates used to calculate liabilities for minimum funding purposes have been stabilized. Roughly speaking, for the past several years, they've been in the range of 5 to 5.5%. And that's even though market interest rates have varied quite a bit in that same time frame. In particular, as you mentioned, 3 years ago, say 2021, market interest rates were actually below 3%. Probably at points during 2021, a benchmark rate you might use to price an annuity purchase might be something like as low as 2.5%, whereas the minimum funding interest rate is in that 5.5% range. And as most plan sponsors will know, higher interest rates means lower liabilities. So when you have a minimum funding interest rate at 5.5%, but an annuity purchase rate at 2.5%, that makes that annuity purchase look really expensive compared to the minimum funding rates. But what we've seen in the last 2 years or so, starting in 2022 and continuing into 2023 and even into today, is that those market rates have come much higher very rapidly, and it basically come back in line with, and in certain circumstances even surpassed the interest rate used for minimum funding. We're sitting here today at a place where if we were doing an annuity purchase today, it would very likely actually be less than the same liability that you have for minimum funding purposes. So in the way that it's been for years now, from an accounting liability or PBGC liability perspective, where an annuity purchase price would be similar to, and perhaps even favorable compared to your financial reporting or PBGC liability, we're finally now in the same situation for the liability that we use to determine cash requirements, contribution requirements, and benefit restriction purposes. So now we find ourselves in a situation that we haven't been in for a long time, where plan sponsors can take this pension risk transfer action, de-risk their plan, move a portion of their retirees to an insurance company, and not take a big financial hit from having to suddenly make much larger cash contributions in order to meet their minimum requirement or avoid benefit restriction purposes.
So it's not that anything has changed on the financial reporting or the PBGC purpose. Those are still, like you mentioned, can be neutral or even favorable to plan sponsors. The only thing that's changed is that we've gone from a situation where, from a cash funding standpoint, it was potentially unfavorable, now to a situation where it could even be favorable. So of those three funded status measurements, looking at it today, we'd say on every single basis, it's most likely favorable to a plan sponsor to actually implement a pension risk transfer transaction.
That's exactly right, Michael. And I referenced this before, but maybe I want to emphasize that when you think about PBGC liability purposes, it's neutral to favorable. But again, the key thing in that PBGC premium context is that your headcount also is a major input into your premiums. The fewer people you have in your plan, generally, the lower your premiums can be, sometimes in certain circumstances, significantly lower, to the tune of something like $700 per person reduction in that premium. And so by going forward with an annuity purchase, you can not only roughly keep your PBGC funded status the same, but you can drastically reduce your headcount. And in many circumstances, that will end up being a really material reduction in that PBGC premium in a single transaction that at the same time is neutral to favorable from a financial reporting perspective. Now, recently, neutral to favorable from a minimum funding cash contribution perspective. And, you can save a really significant cost from that PBGC premium.
So Joe, if I'm a plan sponsor, what are the implications that I need to be considering for a pension risk transfer transaction today?
So, I think, first of all, table stakes is everything we just discussed, right? You want to make sure that you understand what the impact will be on all the liability metrics that matter to you. And that could very well be all the things that we discussed. As we just discussed, we are now in a place where all three of those major liability metrics are all aligned with the annuity purchase market. So that's number one, but we're in a much better place than we've been in there from that cash contribution requirement perspective. The second thing is, okay, so if I'm not gonna go forward with this, when do I do that, right? And that's actually something we've seen become more and more relevant recently. As Michael, you mentioned at the top, these types of transactions have become increasingly popular. We've really seen the interest in the market grow, year over year over year. Now we're at a much bigger market than we were even 2-3 years ago, and because of that, the insurers only have so much capacity to take on these types of transactions. Where it used to be possible to basically start to finish a transaction in about a month, what we're now seeing is even if you start 2 or 2.5 months before you're looking to settle, some insurers are saying, I'm sorry, we've got too much on our plate. So it's really crucial to understand the market dynamics, which insurers are going to be interested in your particular plan profile, and what their capacity is to take on a transaction, making sure you're timing that right. The other thing I'll say is that in particular, these transactions can be very attractive for plan sponsors to make sure they finish up before the end of a calendar year. It often aligns well with their own fiscal year reporting, and it also aligns well with the plan year. Very often we see just calendar year plan years, and that's what determines those minimum required contributions and critically those PBGC premiums. So there can be a really significant value in reducing your headcount in December instead of in January. But by the flip side, that means that the insurers are busiest at those exact times. And the end of the year is a tricky time in the financial markets as well. And so what we often see is the transactions heat up and get most popular right when the insurers have the least capacity to take it on. And so you really want to make sure that you're working with an advisor who can help you walk through all those dynamics, who understands that if you want to settle something before the end of the year, you can't start in September, right? You really need to get going sooner than that if you want to have a successful transaction with a robust and competitive bidding process. And you want to make sure that you really fully appreciate who's going to be interested in taking on your plan liability, and how you're going to make that most attractive to those insurers to get the best process and ultimately the best result.
Yeah, and obviously, Joe, I know you and your team, they work hand in hand with plan sponsors and helping them figure out the timing requirements for what they're looking to achieve. But again, it goes back to what you said. It's making sure that a plan sponsor is working with someone who understands the timing constraints that the insurers are under, so that they can properly situate a potential transaction to get the best outcome possible for a plan sponsor. What about for companies that, let's say, the frozen plan, maybe a little bit underfunded still, looking to terminate at some point? Is a pension risk transfer transaction in the cards for them today?
It's a great question, Michael, and I'll go back to my favorite answer and say it depends, because from a high level, I would say that intuitively that sounds like a great idea, right? It's a plan that's frozen, well funded, but maybe not fully funded. Take some risk off the table without taking too much of a funded status hit, maybe getting a small improvement. Sounds like a great idea, but what we found when we looked at this is that actually many plan sponsors who find themselves in that situation, who are thinking about doing retiree carve out, as we call them, taking a portion of their retirees and moving to an insurance provider, is that actually they're a lot closer than they think they are to being able to fully terminate the entire plan. And when we do that analysis for the plan sponsors we work with, almost universally, we get kind of surprised, like, oh, I didn't realize it was that close, or I didn't realize, I didn't, I thought the contribution would be, 3 or 4 times as large. I'd have to be doing that, over the next 10 years instead of over the next 2. That the time horizon that these plan sponsors find that they could be on in order to already make their budgeted contributions, it tends to be much shorter than what they expect. And what we would generally say is that if you're on a situation where you might terminate the plan in 2, 3, even 5 years, you probably don't want to do PRT right now. What you want to do is really focus on getting that place where you're ready to fully terminate. Because, of course, at the end of the plan termination process, one of the things you'll do is a PRT transaction. But instead of carving out that small portion of retirees, it's everyone left in the plan who doesn't elect a lump sum payment, if that's part of the plan termination process you're using. So there's not a lot of benefit from doing a smaller PRT now if you're just going to do another one 2 years later. In fact, it can actually hurt you, because insurers really like a large retiree population as part of taking on any PRT transaction. Most insurers have limits to how much of the transaction they're willing to take on that's deferred, that isn't yet currently receiving monthly payments. So if you go ahead and buy a group annuity contract for all your retirees, and then 3 years later you're saying, all right, I'm ready to terminate now, and you've got maybe 1 or 2 people who've retired in the interim, the insurers are going to tell you, oh, sorry, I'd be happy to work with you, but I can't make that transaction work. So it's really important to think about the big picture, take that step back, think, how far away am I from plan termination? Is this something that's in the cards for me in the next few years? Is it something I want to do? Is it something I'm capable of doing? And if so, make sure you're really including that in your analysis of any potential retiree carve out in the interim.
Yeah, and I think along with that, right, it's making sure that you've got an accurate estimate of what that plan termination liability looks like, which is generally a range. It's not a point estimate, because there's a lot of variables at stake there that you don't have any control over. And so understanding how wide that range can obviously be very influential there as well. So working with advisors, with consultants like yourself to really hone in on what that range looks like can, like you said, have a pretty strong influence on the direction a plan sponsor takes, whether it's to do a retiree carve out, shrink the size of their plan for the time being, or actually say, maybe we're ready for termination and we can start that process, which can last up to 1 or 2 years anyway.
That's right, Michael. I'm always kind of surprised about the sort of rules of thumb that some advisors are still using that maybe were appropriate 10, 15 years ago, but really don't make sense in today's environment when thinking about, oh yeah, plan termination. Well, you have to be 110% funded. I hear that a lot. In most circumstances, that's just not true anymore. That full funding on an accounting basis means you might be there, or if not, you're really close. Again, every plan is going to depend on their specific provisions, but that's why it's so critical to make sure you're talking to an advisor who works on this type of solution all the time, really understands the ins and outs, and can give you a really thoughtful and well researched response to that question. How much does it cost to terminate?
Well, Joe, I think this is extremely insightful, and I think a lot of plan sponsors will find, especially that notion of they could do a pension risk transfer transaction and find themselves in a better cash funding situation than they were previously, something they probably haven't heard before. So we think about what we want people to walk away with today. One, if you're going to consider a pension risk transfer transaction, understand the implications on all of your funded status basis: accounting, PBGC, minimum funding. And what you may find, like we've talked about today, is that on all three of those, it may actually be economically favorable to transact this year. And then second, make a decision about implementing as soon as possible. As Joe mentioned, there's timing constraints with the insurers. Those are continuing to get bigger the closer and closer we move towards the end of the year. And even though we're attracting new entrants, new insurers to the marketplace, there's still those constraints that exist. And working with Joe and his team can help you figure out what's the optimal way to bring a transaction to market. And then lastly, you really want to understand what the annuity purchase could look like for your plan and your company, and give us a call. We'd be happy to help think through that with you and help you make a good informed decision. Joe, thanks again. Everybody, thanks for tuning in.
Take care, everyone.